Madelaine Jones, who manages European high-yield bonds and European senior loan strategies at Oaktree Capital Management, joins us around the table. Good morning.
Good morning.
A frenzy. I keep hearing that word. There's a lot of issuance. Everybody's trying to get out in advance of some of the big events that are coming towards us. When I hear frenzy, I don't hear a market that feels very selective. But is this a world in which you do need to be selective to prepare for what is coming towards you?
Oh, yes, I think so. I think... Well, we have a good front-row seat on what's going on in companies. We look at hundreds of companies in Europe in some investment-grade debt territory. Last quarter's numbers were very good, but around the edges, on the outlook in particular, you were starting to see some moderation from the beginning of the year. And I'm particularly thinking about chemicals companies here who were reliant on China, reliant on the construction industry to come back. And we've sort of seen those going from expecting a trough and an uptick in demand in the second half of the year to now seeing the trough, which is good, but not seeing the uptick. So you're seeing around the edges a moderation on the outlook, and we've been pricing that in. We've been thinking about that, how we might want to adjust and be more selective. You've seen different parts of Europe having very different growth trajectories. Germany, Northern Europe looking quite challenged, Southern Europe looking better. We've talked at Oaktree a lot about, and we've released a report about the dual economy with different classes of consumer, lower middle income consumer, now being challenged by the rates and inflation that are coming through in more moderate consumer decisions and adjusting consumer behaviour, but the higher income part of the economy doing much better. So there's different fractures in the economy, and we have to adjust and be more selective in light of that.
Given all of that, and given there is clearly some dispersion now in terms of how people are perceiving some of these credits, rates are going to be coming down. Is the rate reduction that we're going to get at a headline level enough to keep even the more stressed credits kind of on the road at this point in time?
Well, some of those credits, and probably we're talking about the loan market more than the bond market, and I appreciate that slide just before on the yields. You know, the bond market now is predominantly double B market, so the quality really is why that spread does seem appropriate, that spread reduction. In the loan market, you do have some structures there which were put on back in 2019, 2018, whose maturities coming due. They were structured around a very low interest rate environment. Yes, we will see a moderation in interest rates, which will help them for sure. But for some of those loan issuers, it won't get to the levels where they start to look like they can refinance easily. Those maturities will start to bite. We'll probably see it 25 and 26. We're expecting peak defaults. But this is a small minority of the loan market. Most of those companies have been able to grow into their balance sheets, have been able to refinance, extend out maturities. So you're talking around the edges 4 or 5%, leaves a lot of the market which is highly investable still.
OK, Madelaine, that's interesting. Just to linger on what you're acknowledging, you say it's a small part of the market, but it's interesting that we're going to get peak defaults at a time when rates are going down and will have been going down for a period. Is that always the case? Is that just sometimes these rate cuts, they just come too late?
Yes, I think so, but you're also reflecting against the rates they were put on at, which were zero and negative, and that's when they structured their balance sheets, not with a view that rates were going to be where they are today. So, you know, that context is vastly different when they were making their balance sheet decisions all those years ago.
On the wider corporate space, away from those more distressed names, and going back to what Guy was talking about the amount of supply we've seen coming in, and typically this is seasonally often a busy period, start of September, and that sort of back-to-school feel. But then there is also the politics that people perhaps want to avoid. So how quiet could things get in issuance terms in the months ahead?
Yeah, no, I think it's going to be really busy. I'm expecting that pull forward. You know, if you're an issuer who's thinking they need to refinance in the next 1 or 2 years, you're seeing the cost of debt has come down quite significantly. And so that looks like a very good time to access the market. The market, of course, the equities market has been quite turbulent, but credit market, it still has a lot of pent-up demand. The supply of high-yield bonds in Europe has been quite modest. So there's a lot of cash that is around to access the market. I think we're looking for opportunities to invest and rotate our portfolios. If we see a little bit of spread widening because of this pressure on the supply, even better, and I think that's a time we'll be very, very active. So I think there's absolutely demand out there. And again, you know, it comes back to selectivity. There will be companies with good quality balance sheets who will find it fine. They may have to pay a little bit more on the spread, but they'll get priced. There'll be the more marginal credits who are really leaving it a bit late to refinance, and, you know, they may not be able to tolerate that little bit of spread widening. They will find it much more challenging. But that's been the case throughout this year. There's been pockets of activity and pockets where the market really has to, you know, take a step back and won't price that marginal company.
What does the maturity wall look like then? Because it kind of feels like there isn't one at the moment when you speak about refinancing. Yeah,
it's been pushed out quite successfully. The capital markets have been open for the last 1.5 years, 2 years. So for any good company who's come to the market, they've found a way, if they have a healthy balance sheet, to refinance it and extend that maturity out. So particularly the loan market's been very active in that. Yeah. And that's why you haven't seen a big need to refinance in these latter parts. And it really comes due really in 2026. We view that as the peak maturity year for legacy loans. The high-yield bond market has been a little bit slower, but you know, we're talking maybe 10% that needs to refinance. And again, we're talking high-quality market, double B space. Companies have been waiting for a good point to access the market and refinance their debt. And, you know, if they're good quality, they shouldn't be troubled by a slight bit of spread widening that we've seen.
You made a key point, which is that capital markets have been open for the last year and a half that you mentioned. You've talked to the folks in the private equity space. They would say, actually, it's not the pace or it's not the adoption or the acceleration that we would really want. To me, I think what's striking, though, is that the capital markets are actually loosening up more in Europe than they seem to be in the States, despite the economic resilience in the States kind of being what feels like is driving some of the macro story. And I'm curious why maybe Europe seems to be a little bit ahead of the game, not just on capital markets, but even in something like the leveraged loan market, for example. And I can appreciate you specifying high yield credit, but those all have factors. Your thoughts on that regional divergence?
Well, I think the loan market in the US has also been very active. I think there have been some challenges in the loan market in the US on some restructurings, which maybe have clouded the news. But that capital market has been alive. I think mainly the reason why it's been active in both the US and Europe, CLO market has recovered very successfully. Yeah. And with that being the major buyer of loans, we've seen activity on both sides of the pond being very good. And that's enabled those companies to refinance. And that's why we see a very, very limited amount of stress in the market, because successful companies have pushed out their maturities.
Yeah, the structured finance piece is also a fascinating one in terms of structuring the buyouts that some of the private equity firms are facing as well. A final question to you on that regional divergence. When we're talking a lot about the carry trade, we had a guest from JP Morgan talking about issuance last week, joining the program as well. And he was basically saying that there's now more American companies that are looking to issue in Europe to take advantage of the interest rate differential. Are you seeing that in your part of the market?
We've seen that, you know, more in a global context. So I think global diversified companies will see a useful place to issue in European debt to offset any currency need they have in their operational side. We have yet to see a lot of, you know, raising of European debt outside of that. So I think it does make sense, but I haven't seen a step change at the moment.
All right, Madelaine Jones, we will leave the conversation there. Of course, managing the European high-yield bond and European senior loan strategies over at Oaktree Capital Management. A really fascinating conversation, Guy, around some of the credits that we're seeing.